You're sitting at a red light on your morning commute, just looking out the window.
Yeah, we've all been there.
Right, and you see like a tiny drive-through coffee shop or a sprawling strip mall, maybe a cluster of light industrial warehouses off in the distance.
Just the usual background scenery.
Exactly. To most people, that's just the daily grind. Concrete, glass, asphalt. But if you look a little closer, you are actually driving through this massive high-stakes financial matrix.
Oh, it is entirely a matrix. I mean, every single one of those structures represents a really calculated bet.
Bet by who, exactly?
By institutional and private capital. They're placing bets on exactly where the macroeconomy is heading. And once you learn how to read the underlying code of these assets...
The code being what, the leases and stuff?
Yeah, their lease structures, their traffic counts, their debt stacks. Once you see that, you never look at a mundane highway intersection the same way again.
Well, today, we are handing you the decoder ring. Welcome to the deep dive.
Glad to be here for this one.
Our mission today is to analyze this highly curated, totally insider commercial real estate dispatch that actually just dropped today, March 21st, 2026.
Hot off the presses.
Literally. This intelligence comes to us from the Eureka Business Group, or EBG. They're a Texas-based full-service brokerage that's been navigating these commercial waters since 2008.
A long time to be in the game?
Yeah, they've seen some cycles. We're dissecting an investor newsletter authored by their managing principal, Joseph Gazalan. We really want to uncover the hidden strategies these dealmakers are using to exploit what is honestly a deeply volatile Q1 2026 economy.
And what makes this specific dispatch so compelling is that it's not just, a randomized list of Texas properties.
Right, it's more intentional than that.
Exactly. It functions as this real-time heat map of capital flows. By reverse engineering EBG's selected portfolio, we can see exactly how savvy money is maneuvering around things like inflation, debt costs, and shifting consumer geography.
But before we put the individual properties under the microscope, we have to establish the macroeconomic weather that's really shaping the board right now.
The big picture.
Yeah. So we are closing out the first quarter of 2026. And the broader world is dealing with an ongoing war that just continues to send these severe shockwaves through global energy prices.
Which heavily impacts operational expenses for businesses everywhere, right?
Exactly. And domestically, the Federal Reserve has left its benchmark interest rates unchanged. They're keeping the overarching cost of capital pretty high.
But EBG's dispatch reveals this massive plot twist.
Yes. Okay, let's unpack this, because despite the Fed holding the line, EBG reports that regional banks have actually started cutting interest rates for prime commercial real estate.
Yeah, they noted they just had a client lock in a 5.75% rate.
Which is wild.
That 5.75% figure is basically the skeleton key to this entire market update. I mean, for the last couple of years, the commercial market has been effectively frozen this giant staring contest.
Right, because sellers were anchored to those glory days of 2021.
Yeah, holding out for those highly lucrative 6% cap rates, while buyers, meanwhile, were handcuffed by 7 or 8% commercial loan rates.
Which just mathematically broke the market. It's like, okay, think of it like someone trying to sell a used car right now. Right?
Well, that's a perfect analogy.
Right. Like, they have this 2022 peak pricing stuck in their head. They see their neighbor sold a beat-up sedan for top dollar back then, so they demand the same price today, even though financing a car now costs twice as much.
And buyers are just walking away.
Exactly, because if you are a commercial buyer taking on debt at 7.5% to acquire a property that only yields a 5.5% cap rate,
you're stepping right into negative leverage.
Which means your cost of capital is higher than your unlevered yield. The property is basically draining your cash flow from day one.
You're subsidizing the building.
Yeah. Buyers just couldn't transact without demanding a massive price reduction, and sellers absolutely refused to take the haircut. It was this game of financial musical chairs where the music stopped in 2022, but sellers flat out refused to give up their seats.
But now, however, the bank is quietly offering them a slightly more comfortable chair to move to.
And sellers are finally capitulating. So how does that 5.75% bank rate act as the catalyst for breaking this stalemate?
What's fascinating here is the psychology of that seller capitulation. I mean, sellers are finally accepting that the zero interest rate cavalry is never coming over the hill to save their 2021 valuations.
The dream is dead.
The dream is absolutely dead. Combine that psychological surrender with banks suddenly being hungry enough to deploy capital at 5.75%, and suddenly the math works again.
The negative leverage trap just sort of
dissolves. Exactly. That 125 basis point drop in debt cost completely revitalizes the cash-on-cash return for the buyer. The bid-ask spread is violently compressing right now.
Which is why EBG's overarching directive to their investors in this newsletter is so aggressive. They literally say, make offers and negotiate those good deals into great deals.
Because the window is open.
Right. The ice is thawing, the capital is unfreezing. But that forces us to look at exactly where this newly liquid capital is actually flowing, because the dispatch paints a really stark divide between asset classes.
Not all buildings are created equal right now.
Definitely not. EBG notes that multifamily assets are continuing to take on water, essentially struggling.
Yeah.
But conversely, retail and industrial sectors are remaining remarkably strong. EBG even brands itself heavily in the newsletter as your retail navigator.
Which is a bold claim right now.
It is. And wait a minute, I have to push back on this data a bit. The newsletter explicitly admits that overall leasing activity is softening.
True, they do say that.
So in an environment where, e-commerce logistics are getting faster and consumer spending is squeezed by inflation, how can a broker realistically frame physical retail and industrial as a strong defensive play? If leasing is softening, how are they strong?
It's a really crucial distinction to make. Because in commercial real estate, strength during a volatile quarter isn't just measured by frantic, high-volume new lease absorption.
Okay, so what is it measured by?
It's measured by tenant stickiness and replacement costs. You look at multifamily right now, and it is bleeding because of the massive oversupply. Developers broke ground on thousands of units 3 years ago, right?
Right, when money was cheap.
Exactly. And now those units are all hitting the market simultaneously. It's forcing apartment landlords into this brutal concession war.
Like offering free rent.
Yeah, offering 2, sometimes 3 months of free rent just to stabilize their occupancy. And that absolutely obliterates their net operating income.
I mean, that makes sense because an apartment tenant has virtually zero switching costs.
Yeah.
If the building across the street offers a month free, you just, hire a mover for $500 and leave.
Boom, you're gone.
Right.
But a retail or industrial tenant just doesn't have that luxury.
Because of the build-out.
Precisely. If you operate a successful local restaurant or a medical clinic or a really specialized logistics bay, you have hundreds of thousands of dollars sunk into your physical build-out.
You can't just pick up your commercial kitchen and move it down the block.
Exactly. Your customer base or your supply chain routing is hyper-localized to that specific intersection. You cannot just pack up and move across town to save 50 cents a square foot on rent.
Right.
So even if the velocity of new retail leases is slowing down, the existing rent rolls are acting like a fortress.
That's a great way to put it.
Commercial investors feel safer rotating capital into retail and industrial because those localized revenue streams offer far more predictability than, say, a saturated Sunbelt apartment market.
Okay, so let's look at how that fortress strategy actually executes at the entry-level tier. EBG lists some really fascinating plays for an investor trying to get in at the under $2 million mark.
The bread and butter deals.
Right. First, we have this tiny 510 square foot single-tenant retail building in the Houston MSA.
510 square feet is incredibly small.
Here's where it gets really interesting, though. That is the size of a small apartment, but it's brand new 2026 construction with a 15-year absolute NNN lease. And it's occupied by a high-growth national tenant. The imagery shows a 7-brew coffee drive-thru. Oh, those are popping up everywhere.
Yeah. So for the listener who might not be familiar with the day-to-day of commercial structures, what does an absolute NNN or triple net lease actually mean for an investor's daily life?
It is the ultimate duration play. An absolute NNN lease means zero landlord responsibility.
Zero.
None. The tenant absorbs 100% of the property taxes, the building insurance, and all the maintenance. If the roof leaks, the tenant pays for it. If the HVAC breaks, the tenant fixes it.
Wow.
It is essentially the most hands-off passive income vehicle you can buy in real estate. In a macro environment where we just discussed global energy shocks driving up operational costs.
You're protected from all of that.
Exactly. Locking in a 15-year absolute NNN lease with a corporate guarantor isn't just buying a coffee shop. It's essentially buying a high-yield corporate bond wrapped in a real estate depreciation schedule. You are immunizing your capital against operating expense inflation for a decade and a half. That is incredibly appealing. But then EDG brilliantly juxtaposes that hands-off asset with a completely different mechanical strategy in the exact same price tier.
Yeah, they really run the gamut here.
They list a 2,884 square foot retail space in Carrollton, Texas. It's got a 10-year lease, a national tenant with over 100 locations, sitting right on a high-traffic hard corner.
A very solid traditional play.
But then they pivot to a 2,900 square foot medical office property in McKinney, Texas, and this one is selling below the county assessed value with owner financing available.
Ah, the owner financing. That fundamentally changes the risk profile.
Right, because if you have banks pricing commercial debt at 5.75%, going through traditional underwriting still requires, appraisals, environmental phases, and really rigid loan-to-value maximum.
It's a headache.
It is, but if you utilize owner financing, the buyer bypasses all that institutional friction entirely.
You negotiate everything directly with the seller.
Right. You sit down and negotiate the amortization schedule, the down payment, the interest rate, and if you are buying it below the county assessed value, like this McKinney property.
You're walking into the transaction with baked-in equity on day one.
Exactly. It perfectly illustrates EBG's core strategy here of negotiating creative, great deals.
It does require a much heavier operational lift than, say, the Absolute NNN coffee shop in Houston. But if the Houston property is about safe capital preservation, the McKinney Medical Office is about aggressive yield generation through customized debt.
Okay, so let's shift gears. Because for those looking beyond safe passive income to, active growth and higher risk reward, the strategy shifts significantly when we move up a weight class into the $2 million to $5 million tier.
This is where you have to roll your sleeves up.
Big time. EBG shifts the focus heavily toward value-add mechanics and unrestricted land. They highlight a 16,800 square foot industrial and flex property in Roanoke, Texas.
Outside the city limits, right?
Yes, outside city limits, features built-out AC offices. But crucially, it has short-term leases, which offers this major value-add or owner-user opportunity. And down on the Gulf Coast, they list a massive 56,400 square foot industrial flex park in Freeport.
That's a huge footprint.
Right, it's this strategic hub, and the rents are currently sitting, quote-unquote, below market. So to me, this is like compare short-term leases and below-market rents to buying a really solid house that is just covered in the ugliest, most outdated wallpaper imaginable.
The ugly wallpaper.
Yes, like it scares off lazy buyers who just want something turnkey, but it is an absolute dream for investors who want to remodel and raise the value.
That analogy is spot on. I mean, lazy capital takes one look at the low trailing 12-month revenue and they just walk away.
Because the numbers look bad today.
Exactly.
Yeah.
But sophisticated capital looks at that short-term lease expiration schedule and starts doing the math. They know they can strip the wallpaper, mark those rents up to 2026 market rates, and force the asset's value through the roof.
It's a totally active strategy.
Yeah, very active. But if we connect this to the bigger picture, the real strategic masterclass in this mid-tier section is EBG's focus on regulatory geography.
You mean the land plays?
Yeah. They list 6 acres of unrestricted land in McKinney. It's got 383 feet of highway frontage on US 380, and they explicitly note it sits in the McKinney ETJ.
The extraterritorial jurisdiction.
Right, and I cannot stress enough why phrases like outside city limits or McKinney ETJ or unrestricted land are absolute gold to investors right now.
Because of the lack of zoning.
Yes. The regulatory arbitrage of ETJ land is massive. US 380 is on DFW's hottest growth path. By acquiring unrestricted land just outside the formal city limits, a developer circumvents all that suffocating bureaucratic red tape.
You don't have to fight the municipal zoning boards.
Exactly. You don't spend 2 years and hundreds of thousands of dollars in carrying costs just fighting a city council for a zoning variance.
Yeah.
You are buying the agility to pivot that dirt to whatever the market demands.
So if the market needs an industrial laydown yard, you build that.
Or a specialized flex park. You get to match the speed of the market rather than the speed of local government. It provides maximum flexibility.
It's pure optionality. Okay, finally, let's scale all the way up to the heavyweights.
The big chess pieces.
Yes, the multi-million-dollar deals to see where the heavyweight institutional-level money is placing its bets. EBG's listings here are incredibly reliant on massive traffic data.
Vehicles per day.
Right. We see a 3,568 square foot retail asset in Dallas, right on Interstate 30, pulling an astonishing 122,000 vehicles per day.
That is a river of cars.
And down near San Antonio, a 47,241 square foot center in Bourne on I-10 captures around 88,000 VPD, and it's in a high-income, fast-growing submarket.
Classic institutional retail place.
But the asset that really demands the most scrutiny is their $10 million plus giant in Fort Worth. It's a 90,501 square foot retail center, a large infill asset near downtown, dense population, but it is only 85% leased.
Ah, there's the hook.
Right. I am genuinely surprised by this one. Why would an institutional buyer spend over $10 million on a massive retail center that is only 85% full? Especially when, in this exact same newsletter, EBG lists another property in Missouri City that is 100% leased.
Why buy the vacancy? Right.
Exactly. Why take on that headache instead of buying the fully stabilized 100% full property?
Because institutional capital doesn't pay retail prices for stabilized assets if they can manufacture the equity themselves.
Okay, walk me through that.
That 15% vacancy isn't a failure or a liability. It is the entire investment thesis. It's the concept of the value add on a massive scale.
Just like the ugly wallpaper, but scaled up.
Precisely. When you buy the 100% leased Missouri City property, you're paying peak pricing. Your upside is totally capped to whatever incremental, 3% annual rent bumps are in the leases.
So it's safe, but slow.
Right. But let's run the math on that Fort Worth property. A 90,000 square foot center at 85% occupancy means you have roughly 13,500 square feet of dark, non-revenue generating space.
Okay, let's contextualize that mathematically. If the market rate for retail in that dense Fort Worth corridor is, let's just say, a conservative $25 per square foot triple net, if a buyer comes in, leverages their leasing network, and fills that 13,500 square feet, they are injecting an additional $337,500 of pure net operating income into the ledger.
And that is exactly where the magic of commercial real estate multipliers happens.
Yeah.
Because you don't just increase the value of the property by the $337,000 of new rent.
You divide it by the cap rate, right?
Yes, you divide that new NRI by the prevailing market cap rate. So if we assume the market values that center at a 6% cap rate, dividing $337,500 by 0.06 equals an instantaneous $5.6 million increase in the underlying equity of the property.
Wait, really? You fill a few empty storefronts and you force $5.6 million of wealth creation out of thin air?
Out of thin air. Filling that remaining 15% is exactly how you force the appreciation of the asset. You turn a good deal into a great one.
That is wild.
That's how the heavyweights operate. They isolate these dense infill locations, acquire the asset at a discount due to the temporary vacancy, and they execute the lease up.
So what does this all mean? We started by talking about looking out the window at ordinary concrete and glass along a commute. But decoding this dispatch reveals that commercial real estate isn't just about bricks and mortar.
Not at all.
It's about reading the economic weather, from war-impacted energy prices to 5.75% bank rates, and finding the right vehicle for the moment, whether that's a tiny 510-square-foot coffee shop for absolute safety or a massive Fort Worth retail center to force millions in appreciation.
It's all about matching the vehicle to the macro climate, which actually raises an important question that I think we have to address.
Oh, lay it on me.
We've talked extensively today about prime locations, massive daily vehicle traffic, driving property value right now.
The 122,000 cars a day in Dallas.
Exactly. But I want you to think about this. As we look toward the 2030s, how will the rapid exponential evolution of AI, autonomous delivery drones, and fully decentralized remote work fundamentally redefine what a prime commercial location even means?
Oh, wow. That completely flips the board.
Right. Will physical highway traffic continue to dictate value? Or will digital infrastructure and drone logistics ultimately render these high-traffic, multi-million-dollar retail corners obsolete?
I mean, if the car doesn't need to drive past the store to get the coffee, the 122,000 vehicles a day suddenly doesn't matter as much.
Exactly. The matrix is always evolving.
It forces you to rethink every building you pass. The next time you are sitting at that red light staring at the sprawling retail center out your window, you really have to ask yourself, are you looking at an impenetrable financial fortress of the future, or are you looking at a tremendously expensive relic of the past?
Something to mull over on the drive home.
Absolutely. Thanks for joining us on this deep dive. We'll catch you next time.